Welcome back. Owen's here for a business update. Hello again, Owen. Now, of course, you've got more on that bailout for Greece. Starting with a look at the markets, though, because that early morning breakthrough was all a bit late for the Asian markets.
A little bit flat on Europe and the Asian markets as well, Claire. As you say, these finance ministers were at it all night. So, in fact, much of the day's trade had been done in Asia by the time we got that breakthrough. Let's just take a look at the European markets first. Pretty choppy. Don't read too much into that. As I say, that deal is just a few hours old. There'll be lots to digest through the day. We'll get into the details of it, particularly the ECB's role in all of this. Let's take a look at the Asian markets as well. As Claire says, a bit of a flat finish and a bit choppy, but the Hang Seng and the Shanghai Composite have both turned positive towards the end of their respective trading days. The Shanghai Composite up around 0.75%. The Nikkei did finish the day a little bit down. Remember, the US markets were closed on Monday, so volumes are likely to be a little bit lighter. Wall Street was shut for a holiday. Let's just look at the euro against the dollar as well. We did see an immediate rebound in the value of the euro against the dollar. It's been on a bit of an upward swing since hitting some fairly low lows in the past few weeks, up just shy of $1.33, so around 0.3% up, as news of that breakthrough began to filter through just before dawn broke this morning.
So we've yet to see any real market reaction to what we've been seeing, what's been happening in Brussels. Let's go through this new bailout, because we've seen some big development from that all-nighter in Brussels. Yeah, and one reason the markets were a bit muted is we knew all along that the headline number for this, that's 130 billion euros of funding. That's to last the Greeks through until 2014. That will allow the government, for example, to pay the wages. Remember, this is a country that's come close on more than one occasion to not having enough money left in the state coffers to pay civil servants, to pay pensions and so on. That will give them that kind of margin now to be able to service those debts. Remember, we've got around 14.5 billion euros of debts maturing exactly a month from now. All of this should help avert that sort of catastrophe. And of course, the crucial thing is to bring those debts down to around 120% of GDP. I don't think for a minute that's anything to be proud of. That's a pretty astronomical amount. A country like Italy has been running debts like that for years and is only now beginning to get into trouble. That's about the limit of what the IMF thinks Greece can sustain while it tries to get the economy back on track. For one person at least, Mario Draghi, the president of the European Central Bank, it was a good deal. Here's what he had to say before he headed for the exit door in Brussels.
We certainly welcome, first and foremost, the commitment of the Greek government to undertake the actions to restore growth and stability. Also, it's very, very important that the program and its implementation be rightly monitored.
That was ECB President Mario Draghi. Now, he didn't mention his role in all of this, but it was crucial, wasn't it?
Yeah, he was a little bit quiet on the details. Understandably, the ECB's role in this has been very sensitive. Remember, the ECB never really wanted to have to step in and rescue Greece on its own. Certainly didn't want to have to buy up its bonds. It has been doing. It's got around 40 billion euros worth. As part of this deal, though, it's understood that the ECB will effectively write off the profits it's been making on those debts and allow those profits to filter down into central banks around Europe, which will again filter back into Greece again to bring down the overall debt. You'll also get new bonds as well as part of this deal. Remember, these private investors who've been holding out for various sorts of haircuts, they're going to write off around half of their debts. For that, they'll get new bonds with a sort of sliding scale of interest rates, starting at around 2%, pretty low, not great. But as time goes on over the next 10 years, that interest rate will rise up to around 4%. So eventually, down the line, they will get their investments back.
Now, you've been having a look at a document that the IMF would rather you didn't read, and it dampens a lot of the optimism that we're seeing here.
And again, traders will have seen this document circulating in the halls of Brussels as this finance meeting was going. Effectively, it was the IMF's doomsday scenario for Greece. Set aside all this optimism about bailouts and so on. What the IMF thinks about Greece right now makes some fairly painful reading. Essentially, the IMF are wondering whether Greece will ever be able to stand on its own 2 feet again, despite people like Mario Draghi saying they're going to put Greece on a path towards growth and sustainability. The IMF is saying maybe not. Maybe investors will be so frightened about this country that they'll never really come back and invest. They're also questioning whether all these labour reforms, making Greece more competitive, driving down wages, well, they think that might actually deepen the recession in Greece. And remember, this is a country whose economy shrank by 7% in the last quarter of 2011. It's only going to grow by maybe 0.5% over the next couple of years. And even after that, only around 2%. These aren't really great numbers for a country that really has to show some dramatic improvements.
Now, I imagine it's now time for some of these finance ministers to be catching up on a lot of overdue sleep, though maybe not all of them.
Spare a thought for the Dutch finance minister, Claire, after pulling a 12-hour or more, I think 14 hours they were at the negotiating table for. He tweeted this little update shortly after the summit wrapped up. He got back to his hotel room in Brussels only to find that his electronic key card no longer worked. Apparently getting into your room after 6 a.m. Was too late for him. So I don't know whether he got a new hotel room. I hope so.
Oh, that's pretty harsh. Now, let's move on to a bit of company news now. The lawyer representing a Chinese firm suing Apple over the iPad trademark says an out-of-court settlement is achievable. ProView Technology claims it owned the copyright to the tablet's name when it was conceived in 2009. It's currently pursuing a number of cases that could stop exports. The latest hearing will take place in Shanghai on Wednesday.
And Lloyds is to take back nearly £1.5 million of bonuses to its former chief executive and 12 other senior executives in retaliation over an insurance mis-selling scandal. The part-nationalised British bank is reclaiming it had to offset £3.2 billion because it mis-sold payment protection insurance. Former boss Eric Daniels will take the biggest hit, losing over a third of a £1.5 million package. Well, Eric Daniels isn't the first executive in the UK to willingly or unwillingly take a little bit less in his or her executive pay package. Stephen Hester at RBS was forced earlier this month to give up his bonus in the latest outcry over executive pay in the UK. And here in France as well, executive pay is beginning to attract the attention of unhappy shareholders, unhappy at the amount bosses take. So the latest plan is to maybe revise the whole game of stock options. Siobhan Silk has the details for us.
From the cosmetics, luxury goods and auto sectors, these are France's 3 best paid CEOs. But their pay packets could soon be lighter on paper. At the moment, all 3 receive stock options as part of their salary packages, giving them the opportunity to cash in when markets are good.
It allows companies to attract talent and secure the loyalty of executives.
It's a significant part of their remuneration. France's #1 earner, Jean-Paul Agon of L'Oréal, made almost €11 million in 2010. 6.8 million of that was in stock options. Agon now says he'll hand back half of those 400,000 options. He also says he plans to end stock options for L'Oréal's 2,300 executives. They'll be replaced by free shares, but only when certain goals related to metrics like sales and profits are met. Several high-profile French companies have already made the change from stock options to free shares. Dairy giant Danone did so 3 years ago, Air France a decade ago. With world markets taking a battering since the financial crisis hit, it's not difficult to persuade executives to make the change.
Right, thanks very much for that look at the day's business news, Owen, and thank you for watching. Do stay tuned to France 24, all the latest headlines coming up in just a few minutes with Chris Moore.